Imagine waking up tomorrow to discover millions of new dollars were created overnight. No trucks, no printing presses, no ink. And yet, your money is now worth a little less. That's not a conspiracy. That's how modern money is actually created. Most people still picture money being born the old way. A government presses bills. A central bank prints cash. End of story. But physical cash is a sideshow now, a prop. The real money, the kind that moves markets, inflates assets, and quietly reshapes your life, is created without printing anything at all. And right now, that matters more than ever, because the amount of money created digitally over the last few decades dwarfs everything that came before it, and most people have no idea how it works. Let's start with a simple scene. You walk into a bank. You apply for a loan. The bank approves it. Where does that money come from? Most people assume the bank takes money from someone else's savings and hands it to you. That feels reasonable. It's also wrong. The bank doesn't move existing money from one place to another. It creates new money out of thin air. Here's the part that sounds fake until you see the math. When a bank gives you a loan, it does two things at the same time. It records a loan asset on its books, and it creates a deposit in your account. That deposit didn't exist before. No one else lost it. It wasn't transferred. It was typed into existence. Your account balance goes up. The money supply expands, not metaphorically, literally. This is how most money in modern economies is born, not by governments, not by printing presses, by banks making loans. In fact, physical cash makes up only a tiny fraction of the money in circulation. In many countries, less than 10%. The rest is digital, entries in databases, promises layered on promises, and it's been this way for a long time. The shift began when economies grew too large and too fast for cash to keep up. Trade expanded. Credit became essential. Banks didn't just store money anymore, they manufactured it. Carefully, legally, and profitably. Now here's where the system gets clever and dangerous. Banks are allowed to create money, but not infinitely. They're constrained by rules, capital requirements, risk limits, regulators. But those limits are looser than most people think. A bank doesn't need to have all the money it lends out sitting in a vault. It only needs a fraction. That's not fraud, that's the design. If banks were forced to lend only money they already had, modern economies would stall. Mortgages would vanish. Businesses wouldn't expand. Growth would slow to a crawl. So we built a system where lending creates money, and debt powers growth. This works beautifully until it doesn't, because every dollar created this way comes with a twin, debt. Money and debt are born together. You can't have one without the other. When loans expand, the money supply expands. When loans contract, money disappears. Which means money isn't permanent. It can evaporate. This is why financial crises feel like money suddenly vanishes, because it does. Now enter central banks. They don't create most money directly. They control the conditions under which banks create it. Interest rates, liquidity, confidence. When a central bank lowers rates, borrowing becomes easier. Loans increase, money expands. When rates rise, lending slows, money growth stalls, or reverses. After the 2008 financial crisis, central banks went further than ever before. They didn't just lower rates, they started buying financial assets on a massive scale. Government bonds, mortgage securities. They paid for them by creating reserves digitally. Again, no printing, just numbers. This was called quantitative easing. It flooded the system with liquidity, stabilized markets, prevented collapse. It also quietly rewired how money flows through the economy. Asset prices soared, stocks, real estate. Meanwhile, everyday wages barely moved. This created the illusion of wealth without the feeling of prosperity. Which brings us to the uncomfortable math. Creating money digitally feels painless at first. No visible cost, no immediate backlash. But money creation doesn't make society richer by default. It redistributes purchasing power. Early recipients benefit most. Late recipients pay through higher prices. This is why inflation isn't just about too much money. It's about where new money goes first. When money flows into assets, prices rise there first. When it reaches everyday goods later, everyone feels it. And once inflation appears, reversing it is painful, because the same system that expands money quickly contracts it brutally. Higher rates slow lending, loans become expensive, defaults rise. Money creation flips into money destruction. This is the cycle. Expansion, confidence, overreach. Then tightening, stress, correction. The irony is that none of this requires physical money at all. The most powerful force in modern finance is accounting. Rows in spreadsheets, risk models, regulatory rules, and trust. Because this entire system works as long as people believe digital money is real, that deposits are safe, that banks will be solvent tomorrow, that central banks are in control. Break that trust and the system freezes, not because there's no money, but because no one wants to lend it into existence anymore. This is why modern money feels both infinite and fragile at the same time. It can be created instantly and vanish just as fast. So when people ask, why don't governments just print money? The answer is subtle. They don't need to. The system prints it for them, quietly, digitally, relentlessly, until inflation shows up or confidence breaks. And that leaves us with a question that has no comfortable answer. If most of our money is created as debt and exists as long as confidence holds, what happens in a world that needs ever more money to function, but can't afford the consequences of creating it?